Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm super excited to have with us Danielle Sesko, who is the Director of Product Management and Innovation at TruStage. We're going to have a fascinating conversation about insurance and innovation in the sector, as well as tracing the impact of fintech throughout the industry and understanding how insurance can be embedded across the different products. With that, Danielle, welcome to the show.
Thank you, Lex. I'm excited to be here.
My pleasure. Let's start with the broader landscape of your career and the sector that you operate in. How did you get started in insurance, and what were some of your foundational experiences?
When I think about my career, I think in regards to insurance, I actually think back a little bit earlier before insurance and back to probably where I started my career in financial services in general. And that was back in 2008, 2009, during one of the largest financial crises of the U.S. And one of the more salient pieces of that financial crisis back in 2008 and 2009 was bank failures and FDIC-assisted acquisitions. And at that time, I was working in financial consulting, and my job turned into actually navigating through those bank failures and FDIC-assisted acquisitions. My clients were the banks that were purchasing and acquiring the failed institutions. And at that time, I really saw my role as ensuring that individuals who had deposits at those companies still had access to their money after everything was done. Our whole goal was to ensure that, alongside the FDIC, that people had access to their funds and there was no disruption. Unfortunately, almost 2 decades later, some of the post-mortem analysis that has been done, it shows that the local communities are still impacted to some degree with higher degrees of unemployment, lower socioeconomic footprints in some regions. And the reason why that was so probably impactful, the footprint of or stamp of my career, was I started understanding the value of having some type of financial backstop in our broader financial ecosystem. We think, government provided, FDIC provided insurance at that point for deposits, but insurance as itself as an industry is a financial backstop for much of our economy, private insurances. And I started realizing the value that insurance itself has on the economy, on local communities. And that took me into a career into insurance, where I've now built about 7 different financial service product categories over my career and 4 brand new insurance products. So I focused much of my career on innovating on insurance itself to help ensure that it's relevant, it's protecting risks that consumers are concerned about, and that it's affordable and easy to access. And that's taken me through a couple different journeys and paths in my career, with cash flow insurance for individuals, cash flow insurance for businesses, pet insurance, and now most recently where I am with TruStage, focusing on the intersection between insurance, fintech, and embedded finance.
We're in a pretty interesting moment in the fintech industry. One of the largest banking as a service providers just got into bankruptcy, and we're seeing a whole bunch of consumer footprints going through something similar to what you described in 2008. People don't have access to their deposits, and it's really a shocking surprise. So you constantly have a rhyme of these events at the highest level if you really zoom out. If you think about insurance and its purpose, can you motivate for us why this industry exists? Like, shouldn't it just be buyer beware? If you put money into a bank that's going to be small, then maybe it'll collapse. Isn't that your fault for choosing the wrong one? Or if you're not making payments on a cash flow product, isn't that really in your control? Like, you decide what you do with your money. How do you motivate the existence of this industry? How do you think about it?
Yeah, the industry itself isn't new. I mean, back in the US, it's been around since the 1700s, and it's dated back many hundreds of years prior to that. But what it is at its core, what insurance is at its core, is it builds financial resiliency. It builds resiliency for the local economy, for businesses, for consumers. I think sometimes it gets mislabeled as a protection product, as it should protect against that consumer who chooses to bank with a small bank or chooses to use a platform where there's some risk, financial risk involved. It doesn't protect against those risks from happening. But what it does is allows for the rational decision making to occur. So it allows for that consumer to possibly bank with a smaller institution or a newer institution if there's proper insurance and safeguards in place. And if something were to happen, these unforeseen events happen, the institution, that consumer have some type of financial safeguard in place. And a lot of our purchases and our economic growth cannot exist, I would argue, without insurance. Most of us could not, take it down to a personal level, most of us cannot sustain a total loss of our houses. So we need homeowners insurance. It's similar as we think about that to I think the corollary applies when we think about that to the financial services industry. Most of us could not live our financial lives and continue to choose to hold our deposits with institutions or make purchases or take on other business ventures without the existence of insurance as a category.
So you have these tail risks that are unpredictable, but then you also have the ability to price those risks and spread them out and support people and companies in doing things that otherwise they wouldn't be able to do, or maybe that could be too destructive. So in broad strokes, what's the kind of entity that you need on the other side to be able to take exposure to some of these catastrophic or highly unlikely events? Is there a repeating shape of an insurance company that you've seen, or is it bespoke every time?
I think there's different flavors and certainly different structures to be successful in the insurance market. But what it does require, though, is probably a consistent set of ingredients or building blocks. At the simplest point, you need an MGA or a producer to bring that policy to market to meet the business who's buying it or the consumer who may be buying it. There needs to be a large carrier, and that's the underwriter of the product. And in order for for insurance to be covered in broad sections or broad pools, which is kind of the ideal scenario for insurance coverage where we protect large pools of diverse risk, it needs to be a large enough entity. Those entities, those carriers, underwriters in the US are regulated on a state by state level. And then depending on sometimes the exposure of those risks or the size of the carrier or the entity, there may also be a reinsurer to take out some of the tail ends of that risk as well. So sometimes we see that so those are the ingredients for insurance companies to be successful. And sometimes it could be 3 different entities. Sometimes that can be a full stack insurer who's possibly working with a reinsurance entity, but the ingredients are still the same, where ultimately there needs to be a relatively large carrier that's assessing and underwriting the risk and has that first position of loss.
How large is large?
It really depends on the type of coverage. So right now I'm working with a company called TruStage, and TruStage is it's not a consumer brand. We're a B2B2C company, but we have over 32 billion in assets under management. So we're a company you've never heard of, we're 32 billion in assets under management. We protect 37 million consumers throughout the US. And I would probably put us not in the category of large, but in the category of a large regional insurer. So billions of dollars of surplus and capital is what's needed to be a carrier in the insurance world, depending on the type of risk.
So you've mentioned that you've built a number of insurance products across your career, and I'm interested in the idea of what innovation means for this industry. Across fintech, for example, a lot of innovation has been around using technology to distribute financial products, or using software machines or artificial intelligence to manufacture financial products in some new way. Can you talk about what innovation has meant in your career and maybe specifically in creating new products? What's involved?
I think there's a lot of different definitions of innovation while we see innovation play out in the insurance industry or insurtech. And I think all those definitions are right, but right in context. Where I've spent most of my career has not been on rebranding companies or finding new ways to market to consumers, where that's innovative and somewhat for the insurance industry, because historically insurance has been sold and not bought through a agency model where there is a licensed agent who meets over the phone or in person in an office and sells an insurance product to someone. So as the industry is starting to evolve more towards digital experiences, we are, and I would say rightfully so, we're calling innovation sometimes digitizing those products. And it absolutely is. It's a form of incremental innovation. Where I focused or chose to focus most of my career has been innovating on the product itself. So the insurance solution itself, not the marketing of the solution or the end-to-end digital experience, though to me that has to be table stakes for today's world. So when I talk about innovating on the insurance product itself, that means creating brand new products for needs that consumers have today. And I think that's an important aspect of the industry and a gap to fill in the industry because consumers' lives have changed, but yet we're working a lot with the same products in the industry that have been around for nearly 100 years. But the way consumers live their lives doesn't look like how we lived our lives back in the 1900s. We now have access to the internet. We're making decisions more quickly through smartphones, through other digital experiences. And that's causing what I would describe more as a kind of a precarious nature in consumers' cash flow, where there can be unexpected disruptions due to loss of income, loss of expenses, and there's sometimes a mismatch between cash flow coming in or cash flow coming out. So when I think about what's needed in today's insurance world or industry to be relevant for consumers, a lot of it relates to critical period cash flow protection, protecting or providing indemnification for loss of expenses or due to loss of income. And to create new insurance products, I think probably the secret ingredient of that recipe is to work with the regulators. Don't work against regulation. The insurance world and the regulations they weren't written with innovation in mind, but there's certainly ways to create something new within existing regulations or to create new markets. Pet insurance, for example, I think is a great example of a relatively new product in the US. I think the first product was issued back in 1981 and it's to a dog named Lassie, a star back in the 1980s because of the show Lassie. But it took still 30 years for the US to create a model law across all by the NCAA for that category of insurance. So the product existed well before that. It was issued, policies existed, but regulation eventually changed over time. But it existed within a period, within a framework that allowed for it to exist. And that's where I think kind of the challenge and uniqueness comes with insurance innovation is truly understanding the regulations and how to fit innovation within regulations. And of course, always working with the state-by-state regulators.
So before we dive into the details of Lassie's coverage, which sounds awesome and fascinating, can you talk about the regulatory structure and who the relevant players actually are? Like if we map that out, how does one engage with these regulators to do what you've described?
In the US, insurance is regulated on a state-by-state basis. So the Department of Insurance is the regulatory agency in the US, and each and every state has its own set of regulations that they've adopted depending on the insurance category that's being examined or referred to. The way to work with regulators is simply on a state-by-state basis. That's absolutely what's needed in the US, given the current structure. It's a matter of always in all cases, contacting the state, which turns into 50 state conversations or 50 state due diligence exams. But that's simply the way to go about it, is to work with literally every single regulator, which can be time consuming for bringing a new product to market. But if we're looking for having entire country coverage, it needs to be done on a 50 state basis.
Well, that's quite a bar to clear, and I can imagine has made insurtech a pretty difficult category in which to start building products. And I guess you also have the other challenge of, if you're building a new product, how do you actually assemble the math to do the underwriting? So maybe if we switch for the moment to TruStage and the product that you're launching there, how was that initial architecture for the underwriting put together before you went out into the market?
And so when we think about kind of pricing adequacy or pricing for the risks that we're covering or insuring, it's really kind of two factors mainly that come into play in the insurance world. And I'll get a little technical here for a second, and that is frequency and severity. So frequency means the frequency of expected losses over the protected population, and severity means the amount of payout for those losses. That's essentially what insurance pricing comes down to at a very basic level. So, and that's defined by the product itself. And what we did at TruStage, we offer a variety of different insurance products, life insurance, home and auto through one of our partners. But what we have been providing probably for one of the longest periods of time of all of our products has been lending related insurance solutions. So we have been providing debt protection, credit insurance for many decades now at this point, where we are covering and protecting consumers' loss of income, disability, or life, and we're making payments on their loan or paying off that loan in case of those events. So we have a kind of this wealth of understanding and experience on how frequently do those events occur for consumers and what's the severity of those occurrences as well. So we use that decades of experience since I think probably about the 1960s, 1970s was the first variation of one of those products. So we have 30 or 40 years of experience just with that one product section, which is a relatively unique product section. We're actually the largest underwriter in the US for that product category. And we took those decades and wealth of experience, and we leveraged it into our newest creation, which is Payment Card, which protects fintechs and digital lenders in the case of borrower experience loss of income. And that's truly kind of a win-win that we've structured with that product, where we're helping the borrower if they were to unexpectedly lose their job or become disabled. And we're helping the fintech lender, which is a relatively new category of lenders in our country, and pay and ensure they're not financially exposed. We're providing some resilience for that lender in case of the borrower possibly missing their loan payments. We're making those loan payments so that we're protecting those loans from going into default. And as a result, we're helping to build more resilient financial portfolios for those companies. And we're helping to protect consumers as well in their financial wealth.
So, if I understand correctly, because as an established underwriter, you have the track record of providing insurance products to lenders on a B2B basis, you've already got something that can be used as kind of a bootstrapping data set to go and replicate that model in digital lending on the fintech side.
Yeah, absolutely. And this is back to my comment of we need to continue to evolve and keep insurance relevant to how consumers are experiencing or how financial institutions are navigating today's economic landscape. And fintech lenders, digital lenders are relatively newer entrants to the market. I don't think the word fintech was coined until 2018, but there's really kind of three forces that are allowing those digital lenders to occur. The first being asset intermediation. We're seeing probably is actually around 60% of private wealth owned now by non-financial institutions, and that's up from 48% in 2008. So we're seeing more asset intermediation, whether it's through private credit lending, securitization. The other trend we're seeing is the componentization of technology. We're not seeing, outside of AI, we're not seeing a lot of, and we haven't for some time, innovation in terms of technology itself. Instead of what we're seeing is standardization, where APIs are becoming a standard part of the digital tech stack. And then consumer preferences, where consumers prefer to take out a loan digitally now versus going into the branch location for a small consumer loan or an auto loan. It's just inconvenient to physically go to a branch. So over the years, we've seen consumers vote with their mobile devices and their keyboards that they want to experience and take out a loan online. They want to shop online. So it's those three themes: asset intermediation, componentization, technology, and consumer preferences, that is changing the lending landscape right now. And that's where, as insurance providers, where we've been providing, TruStage has been providing a insurance solution for face-to-face lending, we've needed to change and evolve to ensure that we're still meeting the needs of today's consumers and today's lenders.
So, you're essentially following the form factor of your customer, which is the lender, to where they do business, which has, at least for some, shifted to the web. I'm really curious as to your point about timing and how big did fintech need to get for this category to emerge? If you think back to Mint.com, that was 2007, and it was the first consumer experience of really money online using Web 2 technologies. But it's taken quite a bit of time to grow and to become mainstream and to become the default, which is sort of where we are now. It's hard to imagine having to go to a bank branch for really anything. How big did the digital lending category have to get to really motivate your business case? Like, when is it a big enough signal that the whole industry has changed platforms? And so now it's interesting for the insurance business to follow.
I think there are kind of two data points I can think of specifically, and that is you referenced the business changing, but I would point to the consumer changing as well. And we're seeing roughly about 2/3 of all loans start online. So consumers are searching first online to get the loan versus going to their branch. And they're preferring to close that loan online as well, though that's where it's an industry is lagging a little bit and ubiquitously providing end-to-end digital lending. But that's starting to change as well. We're starting to see growth rates in end-to-end lending. The other thing we're seeing in the industry is the growth of digital lending technology platforms. So, as I mentioned, technology is componentizing in this industry, and we're seeing roughly about a 25% compound average growth rate in the size of digital lending technology platforms. So, when you think about the aspect of technology on this trajectory of enabling end-to-end digital lending to occur and that trend to continue, and then you combine that with consumer preferences, it's those two things that we point to for the business case to say, yes, we need to be in this space to provide insurance through an end-to-end digital experience. Not that we're not providing it through an omni-channel experience. We'll still provide it through face-to-face transactions as well, or phone transactions, but we need to also be digital. And the reason we need to be digital is because, like I said, the phoneization of tech is starting that trend, but foundationally, consumers want to go online to take out a loan, especially if it is a relatively small dollar cash advance, a personal loan, or they want to take out a loan at a dealership through the dealer versus traditionally going to their physical branch location for a bank, which has been possibly the more traditional route back in prior to the 1990s.
So the same trends that you're describing for lending on the consumer side have also hit the consumer insurance category, right? About half a decade ago, if not more, we saw a number of insurtechs get built on the story of disruption and innovation and so on. But you've described two barriers that are quite difficult to overcome. The first is working with the 50 regulators in a separate process across every state on new products. I mean, that seems pretty tough. And then number two is having a sufficient data set that can make your products actually work well enough and have an engine of math that makes sense. So before we go deeper into digital lending, I'm curious to get your view on insurtech, that sector and the whole vector of change. We haven't seen as many insurtech players scale up as we have, for example, companies in capital markets or in neobanking or in payments technology. What's going on?
I think insurtech can take, like I said, a lot of flavors because the insurance company stack itself can take a couple different variations. What's that needed in terms of core ingredients are the producer that can be a insurtech, a licensed company, but they might not have the scale of data or the regulatory expertise to truly be a carrier. So they need to partner with the carrier and then possibly reinsure as well. I do believe it's difficult to be an early stage insurance company holding all the risk of their insurance portfolio, just given the amount of capital it takes. Like I said, surplus previously needs to be there depending on the number of insureds that insurtechs plan to cover or the type of insurance line or category that they're in. But it's not easy, and I don't think we've seen a lot of insurance companies scale quickly. I think there's definitely some exceptions to that. We probably know their name, we probably all know their names off the top of our heads. But as you mentioned, and as I would add on, insurance needs to be evaluated in the U.S. on a 50-state basis, especially for new product development. And what that requires, and what I've done all throughout my career is work with a strong legal staff, regulatory insurance experts. And that takes finding the right skill set early on in the stage of product development. And then the second thing is having the data set to ensure the risk is priced appropriately. And that comes down to ensuring, put simply, that the insurance company has the capital to pay on the claims when those claims occur. Early stage companies without the capital to pay insurance claims won't be essentially allowed to operate in that state. And that's part of the safeguards that exist in the U.S. economy, and governance over insurance in general is ensuring that insurance companies have the capital to pay their claims. So I think that's a large part of why we haven't seen a lot of truly full stack insurtech carriers scale quickly, is because the barriers to entry are so large. But there are other aspects of where in the insurance value chain where insurtech or technology can add a lot of value. And that would be, I think a lot of the industry right now is looking at improving claim adjudication and timeliness of payments. So assessing claims quicker and faster, and that helps both businesses and consumers when they have experienced the covered loss to get their claim payments as soon as possible so that they can get back on their feet. So while we haven't seen a lot of full stack insurers grow quickly throughout the US, I think there's still opportunity for innovation within the entire value chain of insurance and for insurtech companies to fill those gaps for the industry.
Super interesting. I think another challenge we've seen is that so many venture investors in the private markets do not understand the insurance industry at all. So they end up pricing things as if premiums were the same thing as software as a service revenues. And then you get to the public markets and you've got this huge disconnect between how the company was valued and how it gets valued by equity investors. I think that's created a bit of a fear now as it relates to early stage venture in the insurtech industry. So it does seem to me like you've got to have a couple of advantages in place to actually be able to launch a new product. And one thing that stood out to me is you're saying the digital lending platforms, these emerging digital lending platforms. Can you describe some of the ideal customers for Payment Guard and maybe just what shape they are, whether it's from what kind of products they offer or what kind of software stack they have to have or their maturity stage? Who are your best customers and what do you want them to look like?
Yeah, we created this product to fill a gap of coverage in the industry because many of the companies that we're working with wouldn't be able to get the type of coverage that we're offering elsewhere in the market. So our ideal customer is a digital end-to-end lender, and that could be an entity that is licensed as a financial institution or that is licensed as a consumer finance company, or it could be a technology platform as well. But if they identify themselves as a lender, they have that relationship with the consumer. The consumer sees them not maybe from a technical perspective as their lender, but the entity that they go to access and service their loan. That's the type of company we're working with and ideally looking to continue to work with. One of the things that I think is unique, especially in the digital lending landscape, is companies that are really just truly tech platforms, but what they're doing is providing a service that some financial institutions aren't providing in-house or choosing not to provide in-house. And that service is they're better online marketers. They are able to reach consumers more efficiently and more effectively at scale. They're able to provide a different type of digital experience or a higher value digital experience for that consumer all the way through the end of the servicing their loan, but they're not actually exposed to the financial losses directly of defaults on debt, and they're simply a technology company that the consumer has a relationship with to get their loan. That's a different type of lender than what we've seen emerge probably about 30 years ago, and we're seeing more and more of those types of lenders enter the market and ecosystem now. And that's that lender, because they are quote unquote lender, that technology platform can't access the insurance market in the way that a financial institution could and wouldn't have access to the same type of products that a true financial institution would. So that's the type of lender that we started building our solutions for, because that need is still there. Consumer need is still there. 60%, you can quote any stat that's out there, probably all different stats saying the same thing, of many consumers in the US are living paycheck to paycheck. They're relatively unprepared for an unexpected loss of income. And when consumers experience unexpected loss of income, or they're on this precarious point of being one paycheck away from defaulting on their loan, that impacts the consumer, and then that impacts the technology company, the underlying lender. So what we're trying to do is ensure that ultimately, as mentioned, value of insurance, we're still providing financial resiliency throughout the entire lending value chain. Even though the entrants and the players of that chain might have changed a little bit, we're still looking to provide financial resiliency so that when unexpected things do happen to good people, someone loses their job unexpectedly, that loan isn't going into default. That consumer knows their loan payments are being made. The financial institution's balance sheet is still protected, and the technology partner is still providing a much needed value added service to the consumer who unexpectedly just experienced a loss in income.
So, if I just flesh it out a little bit with an example to make it specific, are we talking about somebody going to Lending Club and getting a loan? Or are we talking about inside of the Shopify app, you've got Klarna and the user's getting a BNPL loan? Or is it Apple and the tech platform and they've got buy now, pay later inside of their wallet? Which of these workflows are you trying to get into?
So right now, we're in the former. We're looking to expand to the latter, but what we're focused on is ensuring that lending insurance is a ubiquitous feature of all loans. Regardless of how the consumer may have accessed the loan, they may have gone through a online aggregator to do some price shopping. We're covering the loans through, for example, through Lending Club for Prosper. We can cover BNPL loans as well. We're covering those specific transactions, regardless of how the consumer may have came about them.
And what's the money flow? Like, who's paying whom? Is it Lending Club that would be paying you the premium for the underwriting on the loan asset that they have, the loan liability that they've got? Or does the consumer know they're buying the insurance so that they're insured inside of this thing? Or how does the whole bit get integrated together?
There's a couple different ways to approach the market. With our current product, Payment Guard, it is a B2B commercial solution. And with that solution, what we designed was we wanted to be truly an embedded component of every loan. And in order to build that insurance solution to be an embedded component of every loan and not actually add friction to the loan experience, that's really important. It's what we've heard from all the digital lenders with its table stakes. Their real estate, their experience for consumers needs to not have any disruption throughout it. So we've built a product that covers the entire portfolio. So all loans originated through that, we'll use Lending Club just as an example here, all loans originated through that company would be covered. But the product would also then be paid for by the commercial entity. So it would be paid for by that digital lender at no cost to the consumer. So the consumer would be aware of the protection. They would know that if they were to experience one of those unexpected events, such as job loss or disability, they would file a claim. We do all the claim review, adjudication, and we make the claim payment to the digital lender. And what that does is it's not a deferment of the consumer's loan; it's an actual pay down of principal. So we'd be paying down a set amount of principal or a set number of monthly payments, so that consumer can get back on their feet, and so that lender's portfolio can be protected from delinquency and default. What that does is, and it's referred to kind of this precarious nature of cash flow previously. And what we're trying to do is get ahead of that loan from even going to delinquent and going into a non-accrual status and then going to charge off. So it's the timing of the cash flow payment that's critically important, of getting it in front of to the consumer and to the underlying loan before it goes into default.
Let me ask a bit more about the economics of this product. For what period is the insurance going to make the consumer whole? Is it 3 months, 6 months, or based on some sort of trigger? Like, what are the conditions? And then in terms of the cost of the service, let's say we assume a 10% interest rate. How many points of interest would go to paying the insurance policy and then other players? Maybe that's not the right way to think about it, but if you had to size it, what would it look like?
And so the product can be structured how in whatever way makes most sense for that lender. And one thing I will say is, as loans go online or especially insurers start to become more prominent in the market, what we're saying is not all loans are structured the same. Some of our customers provide small dollar cash advances in the size of $500 or $1,000 because that's the amount of cash that's relevant for their consumers, whereas some of our customers provide much larger personal loans or auto loans ranging from 20 to 30,000. So our product's structured in a way that makes the most sense for a lender's business and their end consumer. It can be anywhere from up to 6 months of paying loan payments, or it can be paying off the entire loan or a portion of the loan. We're flexible in how we structure the product to ensure that's meeting the needs of our lending partner and their end consumer. So very, very flexible to that degree. In terms of price, how I think about insurance is the come in terms of the value we're doing, and we're providing, like I said, needed critical period cash flow at the time, at the moment that's needed most. So it's not a one for one cost of the premium relative to the cost of cash that we pay out, but it's the timing that's critical. That's the value of it. The other value of it is the differentiation. We're seeing a lot of lenders market this product as a differentiator, and that's helping to drive their conversion rates up relative to their competitors and drive down their acquisition costs. The price varies depending on the particular book that we're insuring and how we're structuring the product. Like I said, it varies depending on the needs of the business customer, but just the general starting point for us is roughly about 15 cents per $100 of benefit. And you can find that on our site as well. And if you're a lender listening to this, interested in learning more, interested in pricing your portfolio, we have an online calculator so you can run some what if scenarios. You can also talk to one of our agents as well to get more definitive pricing, but roughly about 15 cents only for, so 1.5 for $100 of protection. So very nominal costs. And the way we're able to do that is we're protecting an entire book or pool of loans. So we're spreading our risk out, and that's how we're allowing our costs to be so low on a loan, relatively low on a loan by loan basis.
And from a software perspective or a technology perspective, right now there are a lot of trends about embedding fintech and APIs or connecting everything together. But it sounds that the process in this case is handled by the consumer and submitting evidence of their case and so on. Can you talk about the technology integrations between these different industries, the insurance industry and the digital lending industry in your product? And how do you see all of that coming closer together over time? What are the systems that have to be woven together for this whole thing to work?
And I think, truly about that, the value of embedded insurance is really democratizing the supply of insurance by working with insurance companies, working so closely with non-insurance brands, such as lenders, for an example. And that allows us to protect, that allows us as an industry and as, a lending industry as well, protect more consumers and get insurance accessible to more individuals. From a technology integration perspective, depends on how the product's designed, but with payment card, there's actually minimal integration from a technology perspective. And that's because we're truly providing portfolio protection. We chose that path because we've heard that some integrations are painful for technologies to go through to truly integrate some aspects of some insurance categories. So, and despite those companies being tech firms, every product manager has a long roadmap, and their tech teams planned out or scheduled out for the next several quarters. So we designed a solution that is truly portfolio protection that doesn't require really significant integration. Most of our new customers get up and running in a few weeks, depending on their timeline. That's just a matter of ensuring that we're transferring data through the two companies so that we can basically adjudicate our claims. And to do that, it's a simple SFTP transfer. We can certainly set up APIs as well, though most of our lenders actually choose a file transfer protocol approach. So very easy to get up and running. It's actually just about 3 steps for us. And that is because of the way the product's designed itself, which is as portfolio protection and not a consumer opt-in solution, which adds a little bit more friction to the loan experience and also requires a higher degree of integration as well.
Super interesting. I love the use cases of crossover between these different financial services categories and being catalyzed by the change in the underlying behavior of people and therefore the changes in the platforms. And so you've got kind of these jigsaw pieces coming together one after the next, and building out completely new experiences and products like the one that we've talked about. Thank you so much for joining us today and sharing the story. If our listeners want to learn more about the company and about you, where should they go?
They should go to TruStage.com. We have a wonderful site that explains and summarizes everything that I talked about. That's the best way to find us is at TruStage.com.
Fantastic. Thank you for joining us today.
Thanks for having me, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.